Welcome to the Feria TechCast. We'll bring you all things science, engineering, technology, and innovation. Today, we are joined by Jon Morris, seasoned entrepreneur who engineered his own growth from a $10,000 business plan competition win into Rise Interactive, a nearly $40 million digital agency. After 18 years of scaling and eventually selling his company, he now channels that hard-won experience into his current venture, Fiscal Advocate. There, he serves as CEO, leading a tech-enabled finance and strategic planning firm that helps business service companies, including many tech and marketing turn their financial data into a powerful engine for growth. He is on a mission to make finance approachable and actionable, focusing on the key metrics that actually matter to build more profitable and sustainable businesses. So, John, welcome to the show.
Thanks so much for having me. Really excited to be here.
Okay, so quickly, take us back to the beginning. So, what was the vision behind starting Rise Interactive with that business plan competition win?
So, to be honest, I had no interest in starting a business. I was in business school. There was a business plan competition. I liked competition. I thought it'd be fun. And I just wanted to win the competition, which I didn't. I'm still bitter 21 years later that I was second place. But uh, once I started to do well and I finished in second place, and I had all these judges that were these really successful entrepreneurs and venture capitalists and private equity people, I was like, well, maybe I have something here. So that's actually the competition. By doing well in it, changed my heart. And rather than going out and getting a job, I decided to pursue this business.
Amazing. So, what was the pivotal moment that made you transition from running Rise to founding Fiscal Advocate? I hope I'm pronouncing that right.
Yep, you pronounced it right. Yep, fiscal advocate. So I every year, the first business day of the year, I call game day. And I generally spend about 6 months planning for game day. And in 2019, I put my plan together for 2020, and I thought it was a great plan. I was really excited about it. The only problem was it was the exact same plan as 2019. And um, I knew it would do well, but I just felt like I'm not coming across new challenges anymore. I got to a stage where I felt like it was just kind of running the course and running the same playbook. And so that was one reason. The second is, my original exit strategy for Rise was I was going to die one day. I really thought that I was going to, continue this business forever. Uh, but then I got married and then I had kids and the business became very successful and all my wealth was tied up into that one asset. And so I thought it was important to diversify. So that was the second reason. And then the third reason was um, there were just some family things going on where I felt my family needed some more of my attention. So those were kind of the three major pillars that made me decide what I was going to focus on, or make that transition to fiscal advocate.
Amazing. So, could you briefly tell us what Fiscal Advocate is about? I mean, what you do on a day-to-day basis, on a regular day on Fiscal Advocate.
Yep. So we're a tech-enabled finance management and strategic planning company. And to put that in more detail, we help only service-based companies. So people like law firms, architects, engineers, marketing agencies, tech service companies, people who sell their time, we are experts at helping them with managing their finances and helping them with their strategic planning so that they spend their time and their money as intelligently and as effectively as possible. We have three core service offerings. So the first service offering is just pure bookkeeping, invoicing, AR, AP, payroll, month-end close. The second one in the finance department, there's a group called FP&A, or financial planning and analysis. This is really what separates us from everyone else. Is it's budgeting and forecasting, cash flow analysis, resource planning, monthly insights. It's all about the decision making that you're going to do to increase your cash, your profit margin, and your revenue growth. And the third one is strategic planning. We help our clients understand their long term vision, what makes them unique and differentiated from their competition, their annual goals, their quarterly goals. And so those are kind of the three core service offerings.
Great. So, tell us, what's that one financial metric that people are most likely ignoring that could actually transform their businesses?
Yep. So the key to success in the service based industry is knowing what your gross margin is. And I would say that 95% of the companies that come to me have no idea what gross margin is, what their gross margin is, why it's important, or what you need to do about it. So let me just provide a few definitions. When you take your revenue and you subtract what I call cost of service, which is all of the people, the freelancers, the technology, the travel and entertainment, anything that relates to client work, you get your gross profit. So, just to give an example, if you're a $10 million business and you spend $4 million on delivering for your customers, then you're going to have $6 million left over. 10 million minus 4 is the 6 million. Your gross profit would be 6 million, and your gross margin would be that 6 million divided by your revenue, the 10 million, so 60%. Typically, when people come to me, their gross margin is too low. And you get ideally 50% of your revenue is dedicated to your gross margin. If you're below 40%, you are most likely losing money. If you're between 40 and 50%, you're choosing between being profitable or investing in your business. If you're between 50 and 60%, you're right in the sweet spot, right where I want you to be. And if you're above 60%, most likely somebody's getting screwed. You're either under delivering for your customer or you are burning out your team. And the reason why is you're moving into to software related gross margin. And so, we help people understand how to how to find out what your gross margin is, and then how to optimize it so that you can figure out from there where you need to go.
So, tell us, how does a founder's relationship with financial data need to change when moving from product development to scaling mode?
So, you know, it really comes down to your goals. Okay, so one of the things that I do in the strategic planning is I call them owner's goals. And I'm just going to give you two examples. I had two clients, both 5 million in revenue. One of the owner's goals was to go from 5 million to 6 million and never be larger. I had another one that wanted to go from 5 million to 100 million. So those are two vastly different goals. But if you want to go from 5 million to 100 million, then I ask, well, what are you willing to sacrifice on the profit side in order to invest in your business? If the answer is I'm not willing to give up anything on the profit side, well, then you're not really serious about scaling and growing. Because you need to fuel sales and marketing, and you need to fuel engineering and innovation in order to, really put yourself on a path to growth. So it's less about what you do different between one stage and another stage, and it's more about how much you're willing to invest and what your risk tolerance is and where you put your money.
Amazing. So, you talk about unlocking cash without raising capital. So, where is the most common place that you often find hidden cash in the tech company's operations?
Yep. So there's generally only 3 to 4 places. So the first one is that gross margin that I just told you about. So I was gonna give you 2 scenarios. If you're a company that is 10 million in revenue and your gross margin is 30%, that means that you're spending $7 million to deliver, for your customers, and you get to pocket 3 million, and that 3 million you then get to invest back in the business or have profit for yourself. Or if you have a 50% gross margin, like I mentioned before, you're only spending 5 million, you have $5 million left over. So that's $2 million of incremental dollars just by servicing your customers more profitably. So the first place that if you are looking to find more money to fuel innovation and growth is to improve your gross margin. And by the way, I'm speaking about the service-based industry. I really don't care what industry you're in. If you're in manufacturing, if you're in, CPG, whatever the industry is, the more you can improve your gross margin, the more money you're going to have to be able to invest in innovation and other aspects of your business. The second one is there's this area called SG&A. It stands for Selling, General, and Administrative Expenses. That's a fancy way of saying all of your non-client related expenses, all of the expenses that's about operating your business. And there's generally only 3 major categories. There's sales and marketing. There's your back office, or what I call operations and finance, which is HR, legal, corporate IT, general administrative expenses, and finance. And there's your executive team. And then the third, so of those 3, in the service-based industry, you get 30%. Now, if you want more money to fuel growth, and I believe growth comes in sales and marketing, or growth comes in innovation, well, then how do you get your executive compensation or your back office to be a lower percent of revenue? And so you typically get 15% of your revenue for back office. Can you get it to 12%? You typically get 7% for your executive team. Can you get it to 6%? So every time you can make a percentage improvement in one of those buckets, you can reallocate that to fuel growth. The third area, and this is almost the final area, there's one more, is your profits. So, for many, many years, if 20% is the standard and is considered the best in our industry, I targeted only 5% profit for many years. So that was 15% more percentage points I could invest in the business. And if you think about the stock market, the S&P 500, your average return is 7.3%. So rather than having all this money and then investing in the stock market, if you take this money and invest it back in your business, if you can grow at a faster rate than 7.3%, you are better off doing that because you're in control of these investments. You can get a greater return. Now, the only other area is you can go to the capital market. So you can borrow money or you can raise capital via equity that you could use to invest. But I prefer that if you can do it through the funding of your actual business, as opposed to go to the capital markets, that's the route that I generally recommend.
Great. So, tell us, what's the common and wasteful spending habits that you see in the budgets of early stage service companies?
It's really across the board. I'll just give an example. I was looking at a company and they had a sales and marketing budget of $400,000 and 280,000 of it was on a CMO. And, like there's no point in spending that much money on a head of marketing when you don't have any budget for that head of marketing to actually spend. Like what they needed was a marketing manager at that moment in time. I've seen companies where they actually had a negative gross margin, which means that, if their revenue was $10 million, they were spending $11 million on their team to deliver for those customers. It was the best deal possible that the client could ever get. Like, they were getting a team that cost more than what they were actually giving. So, they weren't optimizing in that way whatsoever. I saw company that was 10 million in revenue spending $1 million on their finance department. Uh, you know, so I would say I've not seen like one pattern where it's like these people make this mistake over and over and over again. What I would say is that is generally they just don't have the data organized and they're able to understand how much they should be spending versus how much they are spending in each area.
So, at what specific revenue milestone in the company should the founder stop using spreadsheets and start implementing real financial system?
Look, you're talking to a guy that like at his core is data driven and from day one has had perfect financial books. So to me, uh, I think it is really important that you know where your money is, you know how much you should be spending in each area, and that you're using it to help you with decision making. So if you think about data driven decision making, every decision you make is a leap of faith. We're just trying to make the leap as small as possible. And so if you're just shooting from the hip and you don't have good data to help you make decisions, you're probably making more bad decisions than good decisions.
So, tell us, uh, what's what is the first most impactful action that you'd have a service-based company founder, or say, for example, a tech founder take to turn their financial data into strategic plan?
So there's really not that many things to know, but generally your finances are a mess and you don't have it organized properly. So the first thing I want you to do is you have to unbundle your payroll and you have to unbundle any other expenses and move them to the proper area. So if you have, um, uh, generally when I look at a financial statement, there's one line item that says payroll. And what you need to do is you need to take the people who are doing client work, move them to client work. The people in sales, move them to sales. The people in marketing, move them to marketing. And then I want you to categorize as your main categories cost of service, which is the people doing client work, sales and marketing, operations and finance, executive, and R&D. So every single expense should fall into one of those items. That will allow you very quickly to understand what percent you're spending in those areas. Now, you then want to do a little bit of research to figure out what are the benchmarks in your industry to make sure that you are either underspending or overspending based on strategically what you want to do. So, when I was growing Rise, my competitors who I built good relationships with, some of them a lot smaller than me, would ask me all the time, like, how do you grow so fast? And I would always ask them, I was like, well, what percent of your revenue do you spend on sales and marketing? And the answer was always, we don't spend anything. It's all word of mouth. Well, my goal was to spend the highest percent possible on sales and marketing as a percent of revenue I could. And so I had a massive advantage because I was spending just more on sales and marketing than my competition. And I also spent more in engineering and innovation relative to my competition. And so, um, by me knowing these numbers and by just focusing on a few, how do I improve my gross margin? Every time I improve my gross margin, I put more money into sales and marketing and more into R&D. I am having, a massive advantage relative to my competition and what they're doing.
Amazing. Currently, everybody's talking about AI, AI, AI. So tell us, how is AI changing the game for financial planning and analysis uh, for companies that you've worked with so far?
So, we actually are launching in a little bit over a month our own AI CFO. And so what we're doing is we're taking all of our clients' financial information and think of it as like a chat GPT environment, but it gets down to the transactional level data. So the speed that an analyst can now come up with insights is just so much faster. And, that's going to go across every aspect of your finance department. And so, just imagine if you're up at 1 in the morning and you're like, what clients did I lose over the last 3 months? You don't have to wait for some analyst on your team to do the research to give you the information. All that information is right there. We're calling it Luca, in Luca. And so we're investing very heavily in AI. And we look at it as, and this is an example, we're following the same principles at Rise we're following at Fiscal Advocate, which is, we want an advantage in terms of sales and marketing as a percent of revenue. We want an advantage in terms of, how much we spend on technology and innovation. So we've only been around for 5 years, but I have a really solid, dedicated team to building out technology for us. And we have AI engineers building out, what I believe is a groundbreaking AI solution. And by the way, what everyone has to understand when it comes to AI is generally the needs of whatever you're delivering is not going away. The need for financial insights is not going to go away ever, in my opinion. But the difference is, where do you go to get those financial insights? Who do you hire for those financial insights? And so if you're not embracing AI to think about how you service your customers differently, you're going to be left behind. And so it's really important that you have an AI first approach in almost every business today.
Interesting. So, tell us, John, if you could go back to day one of Rise Interactive and give yourself one piece of financial advice, tell us, what would it be?
It's a great question. I don't know if I know the answer to that. It was an interesting time. I only had $10,000, but I was in business school at the time. And so I kind of looked at it as I wasn't working. So anything I made, I was happy about. But, look, I got an MBA with a focus in finance. I had perfect books from day one. I was making all the right investments. So I would say that a lot of the principles I'm following today were the principles I created back then and there. Actually, here's the one that I would focus on. I did not spend enough time, and for anyone listening to this is a really important thing, is I did not spend enough time focused on cash. I spent my time focusing on revenue growth primarily and profit margins secondarily. But Microsoft bought LinkedIn for $26.2 billion in an all cash deal. If you have lots of cash, you have lots of optionality. And we were for many, many years cash starved. And I really would have focused on the growth in our cash.
Amazing. So I have one more question, John. I normally
Yeah.
like to ask every guest this question that I interview on this podcast. So tell us, in your view, what does innovation mean to you, and how does it relate to your field? I mean, in the context of finance and strategic growth.
So I believe that if you don't innovate, you die.
Oh, wow.
And the whole thing is, I have a couple of different sayings, and one of my sayings is, it can't be a goal unless you put budget against it. And so if you're going to want to be innovative, then you have to budget to be innovative. We spend almost 25% of our revenue on our innovation team here at Fiscal Advocate. At Rise Interactive, I had 25 people at the end dedicated to building out product and technology for us. So it is really important that you have to do a few things, in my opinion, to do it right. So the first thing is, I want to explain the difference between a capital I innovation and a lowercase I innovation. Self-driving cars, putting a man on the moon, um, electric vehicles, the iPad when it first came out, those were all capital I type innovations. That doesn't mean that you can't still innovate if you're not going to come up with the most new groundbreaking thing. So Then there's lowercase I, improving your onboarding experience, launching a new service, making incremental improvements to your existing service, uh, moving your reports from Microsoft Excel to online. Like those are the things that I want you to be thinking about. And what I want you to recognize is that small incremental improvements can have really big impacts. And so, what I tell people is if you think of game day, which is the first business day of the year, by the end of the game, the end of the year, I want your business to be better at the end than it was at the beginning. And I want it to be purposeful so that you know what you're focused in building. Now, you should have an ideal client profile. My ideal client profile is 10 million, $100 million service-based companies, primarily marketing agencies and tech service providers. That's the people that I serve. I then have a vision. I want to improve what I call their CPR score, which is something I created, which is an acronym for cash, profit margin, and revenue growth. Those are the only three KPIs that I care about. And so when I'm innovating, my question is it to help 10 to $100 million service-based companies? And will it improve their CPR score? And that's how I pick my roadmap. And so when you think about all the elements you need a budget for it, you need an ideal client profile, you need a vision of what you're trying to help them do, and then you need to build a team that works in an agile framework where you have sprint releases every 2 weeks coming out, where you have great technology that's getting innovated upon.
Wonderful. So, to conclude, John, tell us, where can our listeners find you or go learn more about Fiscal Advocate?
So they can go to fiscaladvocate.com. You can also follow me on LinkedIn. I post every single week. I never miss a week. And so there's content there. And then you can always email me at jon@fiscaladvocate.com.
Oh, great. So, John, it's been a really wonderful talk with you, and I'm really excited to have you on the show today.
Thank you so much. It's been wonderful being here.